Good afternoon, everyone. Mike and Corey here today. Back from a nice weekend, getting warmer in Ohio at least, hopefully warmer in Texas as well. Getting closer to our office's grand opening, which I'm looking forward to seeing. Today, got some exciting topics. I'm going to do a quick revisit of where the market is this year, because after last Friday, you might feel, if you watch the markets like we do, you might feel like, oh my gosh, it's down on the year, but it's not. So that's good news. Next, then I'm going to hit real quick on child Roth IRAs, or a great way to pass generational wealth. And then I'll hit our 10th ego stock. And then Corey's going to take all he's learned from Warren Buffett and explain it all to us, all this wisdom. And I don't know how old Warren is. He's definitely in his 90s. Is he 98?
94.
94. I know his partner, Charlie Munger, I think he passed away,
Last year.
last year. So, he is just an incredible investor. And if you can read his history, it's incredible. So, but before we get started, remind you this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on AnkerstarWealth.com, and the opinions expressed are mine and Corey and Warren Buffett through Corey's, no, just Corey's, opinions alone. So let me get started with the, I'll call it the good news, because last Friday, if you looked at the market, you'd be like, oh, wow, it was brutal. And you can see this dip. I'm showing a year-to-date graph of the S&P 500. You saw this big drop off. So the day before, we're hitting all-time highs on the S&P 500, and you're thinking, oh, things are going so great. And then we had this big sell-off, and there's always going to be this volatility in the market. Some of what's causing it, I know you're going to hear, tariffs and deportations, but on the real bottom line is the economy growing or slowing? And based on that, will the Fed cut the interest rates or leave them the same? Hopefully they won't raise them. And then, is inflation under control? So those are really the topics that cause a lot of market fluctuation. There was no geopolitical event that I know of last week that would cause that market sell-off. And when I say sell-off, it was really just a dip. So on the year, the S&P 500, on this chart, it shows it up 2.4%. I think I saw somewhere else, maybe it's not quite that high, but it's up. So this is a year-to-date graph. You can see that the number at the end is higher than the number at the beginning, and it's up 0.24% today. I'm going to show you the NASDAQ. It's a little bit more volatile, still down a little bit today, but still up 1.1% on the year. So think of it like this: 1.1% on the year, or actually the S&P up 2%. We're 2 months into the year. We're 1/6 of the way. So if you multiply that number by 6, so 2 times 6 is 12%. That would be a good year. I mean, the last 2 years kind of spoiled us because it was up over 20. NASDAQ, 6 times 1.1 is 6.6. Not as high as we'd like, but certainly not negative or anything. So very typical, I would say, after the past couple years. So I just bring this to bring that perspective. And I guess I'll roll it back and look at a 1-year graph. And this is the kind of thing that I always keep in the back of my mind. You see the volatility along the way, all the ups and downs, and there's bigger dips than last Friday for sure. But if you look at the chart for 1 year, it's definitely up. Okay. So get the privilege of helping the children, who tend to be young adults now, of a lot of clients of mine, and we talk about Roth IRAs. And I just wanted to bring this up, that one of the best ways that if you are the adult parent of I'm going to say a teen to a 20-year-old, that you can pass generational wealth to your kids is through the Roth IRA. But the key is your kid has to be working. They have to have some earned income. And the most that they can contribute is $7,000, but really the most is how much money they earned in a year. So if a kid is 14 years old and they work at McDonald's and they earn $2,000, you as the parent can put $2,000 into their IRA. Although I do encourage you to have your kid put some of their money in. There's no way they're going to put all 2,000 in, but they should always feel that they have some skin in the game. So maybe they're like, you put in 500 and I'll put in the rest or whatever. But it's to get that investing. And the reason why the Roth IRA is such a beautiful thing, and it wasn't there when I was a kid, is it's taxed at their rate now, which is zero. I mean, basically, if they earn $5,000, they're really not paying any federal tax on $5,000. But it's taxed. It's taxed 0%. And then someday, hopefully, when they're 60 years old and it's worth millions, they'll be able to take it out tax-free because they already paid the tax as kids. So that is the key difference between a Roth and a traditional IRA. A traditional IRA, you don't pay the tax now, but you pay it later. But when your kids are paying 0% tax, you want to pay 0% now. So anyways, that's it. And I just wanted to, if you're hearing this and you're like, hey, I'm doing pretty well. I've got, little Johnny or Sally that's 16 years old. They got their first job. They're working at Wendy's and they made a couple thousand. This is the time to get these things set up. The sooner the better. It could be a custodial Roth, and then at age 21, it'll convert over to them. But either way, contact your advisor or send me a question. And this is a fantastic way to pass generational wealth to your kids or grandkids. And then the last thing I'm going to cover is our 10th ego stock. And I will tell you that with market sell-offs and the interest rates staying pretty high, our ego stocks, it's been a tough year so far. So these are smaller companies. They don't have a lot of cash like the big companies. So it has been rough, but we're confident that these are great companies. So this next one, we've had cloud computing, we've had quantum computing, we've had beauty and makeup. We've been all over the place. Very interesting, a diversified portfolio. This is the first one, we've had lots of AI. This is the first one that has to do with digital assets or crypto. So the company is Galaxy Digital, and I'm on their website, and I'm showing this to kind of show they don't just hold Bitcoin. This isn't just a holding for coin or for Bitcoin, but there's several different uses of it. So it's how do you use these digital assets, such as like it's listed here, derivatives, lending and borrowing against them, a platform to trade them, as well as they do have some mining, which is another way to obtain them. This company will definitely travel on the same paths as Bitcoin, or the rest of the digital assets. So, Bitcoin doubles this year. I would expect, at least my thesis is this company would do better than doubling. This is a kind of a leveraged play that it involves a lot of different aspects of digital assets. So this is our only one that I put in here that is actually, really this closely tied to it. Let's see here. I did want to show here. Let's see. I pulled up kind of a summary, but what does Galaxy do? And let the AI from Google explain it. But custodial technology, investment banking, some other things like that. Company founded in 2018. I got to hear their CEO on a conference call, which is how I came to learn about this company. As far as the size, 2.4 billion. So not it's kind of the middle size of our ego stocks. If I reel this thing back and we look at a 1-year chart, you can see it's pretty volatile. Had a nice spike up over 22, but now at this point we're buying area around 1580. Still not trading at crazy all-time highs. And this is our last of our ego stocks. I will tell you that these ego stocks, exponential growth opportunities, these are in very aggressive portfolios. So when I cover it, it's not that we're putting this across our book. It's in the most aggressive portfolios, and these are volatile companies. These companies go up and down 5-10% frequently. They're not like Apple and Amazon. It makes Apple, Amazon, Google, and Nvidia seem like stable, like, you know, like Coca-Cola. I mean, these companies are volatile. I also will say with exponential growth opportunity stocks, you know, we're not like just buying these and saying a year from now, I hope they're there. These are companies that we're following closely with our thesis, and if we see any change on that, if we see, you know, some reason that we lose confidence in them, we will be exiting this investment, even if it's at a loss, and going somewhere else. But as long as we have confidence in these companies, even if they're down 20%, we expect it's going to come back and do well. So I just kind of preparing people for the ride that you get with these kind of companies. And I just look to like last year and know that we had 2 out of 10 that went up over 100% and one that was close to 100%. So, you know, and that was Palantir, Toast were both up over 100%, and Arista Networks was close. So, but there was other ones that were down 40%. So that's why I just prepare you for you know, what this is like. So I don't think Warren Buffett would be investing in these. I'm just going to tell you, this is not where he would live. He always said, you know, invest in what you know. I bet you he probably doesn't know Elf Beauty. I know he doesn't know Rigetti or Fubo, you know. So Corey's going to tell us everything that Warren Buffett knows. Go ahead, Corey.
Yeah, so this weekend we got Berkshire earnings, and we got the annual letter from Warren. And in America, we've got Uncle Sam, we've got Uncle Warren, and then do we have any other uncles that you know of, Mike?
What's that guy in Monopoly? Isn't there a guy in Monopoly? Uncle
Oh,
something?
yeah.
Uncle Moneybags or Money something?
Okay, so those are our three uncles. So, but Uncle Warren, you know, when he speaks, you gotta listen, right? He started off his annual letter this year to Berkshire shareholders, which is really to all investors, right? But he started off talking about mistakes and how Berkshire makes mistakes, and how whenever Berkshire does make mistakes, he tries to be very honest about that, and he'll mention it. And I highlight there, during the 2019 to 2023 period, I have used the word mistake or error 16 times in my letters to you. Many other huge companies have never used either word in that span. So he talks about how, you know, owning up to your successes and your mistakes says a lot about who you are. And if someone or a company is going for an extended period of time without ever mentioning a mistake or an error, then there's probably some things that are not being told to you. From there, in his letter, he talks about one of their CEOs, a CEO of a subsidiary of theirs, Forest River, named Pete Leigel, and he just had never highlighted Pete Leigel in an annual letter before and wanted to take an opportunity to do that. He met Pete in 2005, and Pete was he kind of tells this story about how Pete was just so direct and upfront with him. He said, "Hey, I want to, you know, I've been running this business for a long time. I want to ensure that my family has financial security, and I want to sell to you, and I want to sell to you at this given price." He just told Warren everything as soon as he got to talk to him, and Warren was like, "Okay," and he said, "Yeah, that sounds okay." And he said, "But once I sell to you, I still want to run the company, and I want to run it, you know, to the best of my ability." And Warren said, "Okay." And then at the end, he mentioned, "Well, Pete, what do you think your compensation should be?" And Pete said, "Well, I shouldn't take more than my boss, so I'll take $100,000." Which Warren, Uncle Warren's salary might be $100,000, but he is receiving other compensation benefits in his job. However, he's probably the most modest living billionaire that you'd find. I don't think he's moved houses since the 1950s or something. So very modest, but his full compensation is not just $100,000 that he could access and live on. So anyway, I wanted to highlight that. Interesting. And I don't know how many subsidiaries Berkshire has, but I think it's around 200. And chances are you've seen a Berkshire or Forest River RV pass you on the highway at some point. This is interesting. He mentions in the letter that Berkshire in 2024 paid the IRS $26.8 billion, which is about 5% of what all corporate America paid. So I can't even imagine a company, it's hard to imagine a company bringing in revenue, right, of 27 billion, much less just a tax bill. Isn't that something, Mike?
Crazy.
After that, so one thing I do want to hit on is you'll see on social media or on TV, actually it was on TV today, Berkshire's cash position. Warren is scared. He's got the elephant gun. He can't find an elephant. You see all these things. Berkshire has nothing invested in stocks. He's selling all of his stocks. Well, he had 354 billion in marketable equities, so stocks, and now down to 272 billion. So he did sell some. One thing he mentioned is the value of their non-quoted controlled equities, things like that Pete Leigel's company, and what do they own?
They own part of Geico. I can't remember.
Geico. There's a bunch, obviously. What's the one? Dairy Queen. I mean, we go on and on. So he mentions that those non-quoted equities increased in value, remains much larger than the $272 billion that they have in other stocks. So is Warren scared? Is he wanting to sell his American equities? Not at all. He is, however, having trouble putting that elephant gun to work, as they call it. So, and he does mention they prefer equity ownership over cash equivalent ownership. The next thing is he hits on some stuff in capitalism. So he mentions that what really was special in America is that Americans were not spending everything that they were creating. So we needed many Americans to consistently save, and then needed those savers or other Americans to wisely deploy the capital thus made available. If America had consumed all that it produced, the country would have been spinning its wheels. So from a base of only 4 million people, and despite a brutal internal war early on, pitting one American against another, America changed the world in the blink of a celestial eye. First of all, I had to highlight that. That's giving, he's channeling his inner Carl Sagan there. But on top of that, he's just highlighting that capital formation requires savers, and it requires people to deploy capital in wise ways. So he mentioned that in a very minor way, Berkshire shareholders have participated in the American miracle by foregoing dividends, thereby electing to reinvest rather than consume. He mentioned that he did pay one dividend, I think in like 1967, and he couldn't remember why, and he thought it was really dumb that he did that, and he wished he wouldn't have done that. But other than that, he's never paid a dividend. And he said, so I want to show you a little something about what he's talking about with dividends being reinvested or not. And then he did mention, just really quick, he and Charlie acknowledged that Berkshire would have not achieved these results in any other country, but America would have been totally fine without them, without Berkshire. So kind of just very humble and interesting there. So here's, you can see the last 10 years returns. So you've got in purple, this is just the S&P 500 with somebody spending their dividends. Maybe they're, I don't know, buying some Geico insurance or something with those dividends. And then you've got the orange line, which is the S&P 500 total return with dividends reinvested. Mike, between those, which would you rather have? Would you rather have the orange or the purple line? What do you think?
Well, of course I want the orange line.
Yeah, so it takes a lot of discipline. And then, of course, you see the blue line. That's Berkshire over 10 years. Are they beating the S&P 500? Well, of course they are. Why? Because they are consolidating all those dividends and reinvesting them for further growth. And then I pull up a longer chart. You've got Berkshire, you've got the S&P 500 total return with dividends reinvested. Oh, and I made these charts. Shout out to Y Charts, our Ankerstar Wealth Y charts. And then you've got the purple line, which is just the S&P 500 if you're spending your dividends. So you can see over a 30-year, a little more than 30-year investment time horizon, those small dividends that come in each year, maybe your portfolio averages 2% a year. It may seem a little bit like an insignificant source of income. However, if you have the discipline or the ability to delay spending those dividends, and you have the discipline to reinvest those dividends, you will dramatically outperform the alternative of spending those dividends. And, Berkshire, it's funny, Warren shows all this humility, right? And then you go and look at the results. It would be very easy for him to beat his chest if he wanted to, but he chooses not to. Okay, this is that cash pile. The largest percentage of assets held as cash for Berkshire, and you could see that only similar time frame in history was prior to the great financial crisis, so he had great timing there. Is Warren predicting another great financial crisis? No, not really. He's just having trouble deploying cash. And then here's the other. This is the opposite of that. These are fund managers. So Warren's kind of stacking up cash. Fund managers are, pumping as much cash as they can into the market. So very low levels of cash. Presumably, these fund managers are trying to beat the market. And if you've made it this far, Steve did want me to mention that here at Ankerstar Wealth, we're currently sitting around 9% cash. So we are, ready to deploy cash as opportunities arise, in the coming months and beyond. So anyway, that's it for me. Oh, wait, yeah, that's it for me. And hopefully that helps. Now it saves you. You don't have to go read Warren's letter.
Hey, I just wanted to say too, you may be wondering about do we reinvest dividends? So as Corey was going through that, and you see Warren reinvest dividends, and then you see that return. So the answer would be yes, we do, but it might not necessarily be in the same investment. So what we do is we rebalance accounts. So if for example, you're in a company that generates a lot of dividends, so you're generating this cash that comes into your account, and you'll see it paid, some are paid monthly, some are quarterly, but you'll see those dividends come in, and then when we rebalance the account, we reinvest it. So, and then you have the same percentage. So essentially, we are reinvesting the dividends unless you choose to take them out, or you choose to take that as a payment, which there may be a time in life that is absolutely the right thing to do. So, there's nothing wrong with not reinvesting dividends. You just understand that, one provides a total return, and part of the reason you want to build your wealth is that you can live off the dividends, or you can live off that. So anyways, that's good. It is Monday. Thanks everybody for hopping on. We will talk to you later. Bye.